Now, to borrow a phrase from a soliloquy in Shakespeare's Prince Hamlet, to pause or not to pause is a question, albeit a different question, that investors have been toying with coming into Wednesday's Fed meeting. Now, analysts are generally quite divided on what the Federal Reserve will do. Some are pushing forward, like Goldman Sachs, that the Fed will maintain and even extend their hawkish stance by pushing the terminal rate above 5%. I've also read an analyst from JP Morgan who's saying that actually, in contrast, the Fed is going to start to signal a coming pause, and maybe there's the outside chance of the Fed surprising markets with a lower 50 basis points hike. And remember, there's 75 basis points expected. So if the Fed do surprise in the event to the dovish side, that would typically mean a large boost higher in the S&P 500. Lower interest rates mean lower debt repayments for companies and more spare consumer cash for those consumers to spend in US companies. So if we do see a surprise from the Fed to the dovish side, and they're raising interest rates at a slower pace than the market's currently expecting, then the S&P 500 seasonals become really quite relevant. And you can see over the last 25 years, between November the 1st and December the 31st, the S&P 500 has a very strong seasonal period. You see, the weakest years, in 2000, the global financial crisis, 2007, 2008, there was a downturn in stocks generally in 2018. So if you took those outlier years out, which you can easily do with SeasonX, you can just go to here and we'll say, okay, let's take out 2008, 2007. Let's also take out 2018. And then you can see actually, it does improve the returns as well, with an average 4.12% return. So major trade risks. Obviously, the major trade risk here is if the Fed take a definite hawkish stance, that can send US stocks lower for another leg and would be negative for stocks. Remember, don't just trade it, but season exit.